Earn up to 13% on oil and gas bonds. Would we invest? What about you? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So ads similar to this one, promising 9 to 13% annual interest on oil and gas investments, have become almost a fixture on social media. And we've been getting a lot of questions from our Diamond NestEgg regulars on whether it might be worth having a closer look at these bond offerings from Phoenix Energy, formerly known as Phoenix Capital. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Who is Phoenix Energy and how risky is what they do? 2. What are the risks and restrictions of investing in a private placement? And 3. Would we personally invest in Phoenix Energy? As usual, here's our front of video disclaimer. And please do take note of point number 5 in particular. This content is not sponsored by any of the companies that may be mentioned in this video, nor do we receive any compensation from them if you choose to do business with any of them. As customary, we will lay out the facts about Phoenix, give you our perspective as appropriate, and leave it with you to decide what is best for your individual circumstances, goals, and expectations. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Who is Phoenix Energy and how risky is what they do? So, Phoenix Energy was founded in 2019 as Phoenix Capital Group in Will County on the outskirts of Chicago by the Ferrari family, and a family member, Adam Ferrari, is the current CEO of the firm. Starting basically from scratch, Phoenix grew very fast, and according to their most recent annual report as of December 31st, 2024, they had 135 employees in 5 offices across the U.S., including their principal executive office, located in Irvine, California. Phoenix's business model can be summarized as follows. First, they raise money from investors, to a large extent in the form of high-yielding debt instruments. We'll talk more about the legal structure they use to issue their bonds later on. Second, Phoenix takes this money and buys or leases mineral rights from landowners. This gives them the right to drill for oil and gas, and it seems mostly oil and gas from what we could see. Other minerals don't really appear to play a big role. And third, Phoenix assumes the entrepreneurial and financial risks for the exploration and production of the oil and gas, a role that the energy industry calls a working interest, meaning that it's essentially Phoenix's responsibility to get the oil and gas out of the ground and to the market. To do this, Phoenix either works with partners for the exploration and production, the actual drilling and pumping, or they do it themselves out of the operating department that Phoenix launched relatively recently in 2023. And the establishment of this operating department also seems to be the reason why they changed their name to Phoenix Energy from Phoenix Capital, to indicate that they now do more than just raise and invest the capital. Now, as many of us know from the gas prices at the pump, oil and gas can be a cyclical business. Always has been, probably always will be. So it's not a surprise that Phoenix itself names, among others, the following 3 risks. The business of drilling and extracting minerals and acquisition of mineral rights are highly competitive, and the business involves many uncertainties. Our business is sensitive to the price of oil and gas, and declines in prices may adversely affect us. We have limited operating history and have experienced significant business growth in a short time, making it difficult to evaluate our business and prospects. This last point here about the risks of being a young company that is growing fast deserves a closer look. The good thing for investors is that Phoenix is registered with the SEC, the Securities and Exchange Commission, which means that we can get some good insights into how they're doing from the financial reports that they file publicly on a regular basis, giving us probably as much information or even a bit more than we can reasonably expect for a non-listed company. So, let's look at what we can learn from their last published numbers for the full year 2024. These numbers were just published on April 1st. And let's start with revenues, which confirm that Phoenix indeed grew very fast over the past 3 years. Total revenues went from a bit above $54 million in 2022 to just about $118 million in 2023 and $281 million in 2024, basically up 5 times over this period. And in 2024, you see for the first time separate revenues from product sales, these $126 million here, which are a result of Phoenix Operations Department going live and pumping and selling their own oil. In the previous years, they just had mineral and royalty revenues from their partners who did the actual exploration and production for them, as I mentioned before. So far, so good. When we look at the bottom line, though, the picture gets a bit more complex. While Phoenix showed a positive net income of a bit less than $6 million in 2022, this swung to a loss of about $16 million for 2023 and an even larger loss of nearly $25 million for 2024. Now, increasing losses are not uncommon for fast-growing companies who have to invest first before the revenues and profits follow. And the silver lining here, so to speak, is that Phoenix losses grew only by about half, by 53% to be precise, from 2023 to 2024, while total revenues more than doubled, increasing by 138% from 2023 to 2024. But still, losses are losses. Total operating expenses grew by 142% last year, from slightly above $86 million in 2023 to nearly $209 million in 2024, presumably driven by the build-out of the operations department as well. Interest expense, including the high coupons that I showed you at the beginning of this video that you could earn as an investor in Phoenix's bonds, grew a bit slower, but still almost doubled from about $48 million in 2023 to approximately $90 million in 2024, a growth rate of 88% over the one-year period. Now, let's have a look at Phoenix's balance sheet. On the asset side, cash and cash equivalents made a big jump from only a bit more than $5 million in 2023 to almost $121 million at the end of 2024, which should be a stabilizing factor. Overall, total assets more than doubled to a bit more than $1 billion in 2024, from around $493 million at the end of 2023. On the liability side, long-term debt, again including these high-yield bond offerings that are often advertised on social media, long-term debt grew to slightly above $795 million in 2024, up 169% from the $295 million at the end of the previous year. And shareholder equity went deeper into the negative to minus $34 million at the end of 2024 versus about minus $5 million in 2023, driven by the accumulated deficit or losses that Phoenix is carrying. Overall, the annual report confirms the picture of a fast-growing but also highly leveraged, highly indebted company that may have to use a part of the new debt it raises to make not just the principal, but also interest payments on its existing debt. And while they hope to change this in the future, there is no guarantee, as Phoenix itself points out in its annual 1K filing. Although we expect our cash flows from operations to be sufficient to service such obligations going forward, there can be no assurance. As a result, we may use the proceeds of additional debt to make interest and principal payments on our existing debt. As our Diamond NestEgg regulars hear me say often, one of the fundamental pillars of investing is higher risk, higher return. And Phoenix is no different. If you invest in Phoenix, you are promised an attractive coupon, but you are essentially lending your money to a company that is already highly leveraged, that already has a ton of debt basically, and probably doesn't have all that much room for error if something goes wrong. For example, if their growth slows and or oil and gas prices suddenly come down. But more about that later. Also, keep in mind that the bonds that are being advertised and sold by Phoenix are an unsecured and subordinated obligation of the company, as the private placement memorandum, essentially the fine print of the offering, points out here. meaning that as an investor in these bonds, you may pretty much come close to last in the case of an insolvency. But let's say you trust Phoenix's leadership and management to continue on their growth trajectory, and that you might be willing to consider investing a bit of your money into Phoenix as part of a larger diversified portfolio. There's still some additional factors you need to consider, bringing us nicely to the next section of today's video. What are the risks and restrictions of investing in a private placement? As Phoenix explains on their website, their offering is structured as a private placement, what the market calls an offering under Regulation D. This means that the bonds are not registered with the SEC. Issuing the bonds as a private placement has two main consequences for you as a potential Phoenix investor. First, an investment into this private placement requires a minimum of $25,000 and is open only to accredited investors. Accredited investors are defined as having a net worth over $1 million, excluding primary residence, or income over $200,000 as an individual or $300,000 as a household in each of the prior 2 years, and reasonably expect the same for the current year. Second, because the bonds are not registered with the SEC, they cannot be traded freely, and the liquidity of your investment will be limited. While you can choose to receive your interest payments monthly for a steady income stream, as opposed to letting the interest accrue until the debt matures, it may be more of a challenge if you want to get out of your investment early. For example, if you need to access some money from your principal. Unlike for listed securities, private placements generally don't have a readily accessible secondary market where you could sell them. So your best hope is usually to redeem early with the issuer. And indeed, Phoenix gives you what they call a limited right to redeem your bonds early at 95% of the aggregate principal plus accrued and unpaid interest, which doesn't sound too bad. That said, there are limitations, and they also disclose that they may not, however, be able to pay you the required price for the bonds that you want to redeem early if they just do not have enough funds at the time, or the terms of their indebtedness prevent them from making such payment, meaning conditions imposed by other creditors do not allow them to do so. And speaking about early redemptions, Phoenix, on the other side, can call the bonds early at their discretion. We may redeem the bonds in whole or in part without penalty at any time, as the private placement memorandum clearly states. So there's no call protection at all, and your investment may be returned to you at any time, exposing you to reinvestment risk. That said, Phoenix does advertise on their website a 97% investor satisfaction rating from a poll of 542 current investors. They also state that they've made 100% of their interest payments on time since inception. Whether inception refers to when Phoenix was founded in 2019 or some later date is unclear based on what we could see. Phoenix also tells us that they've paid $82 million of interest to bondholders. But from their footnote here, you can see that the $82 million in total interest paid is reflective of total interest paid and accrued, if we're precise. Right. So, now that we know who Phoenix is, what they do, and the risk and restrictions of investing in a private placement, let's move on to the next section of today's video. Would we personally invest in Phoenix Energy? As we just discussed, Phoenix is a company that regularly files financial reports with the SEC, which gives us some good insight into their numbers and history. Now, I'm not an oil and gas expert, and I don't have a strong personal conviction here. But then again, I would venture a guess and say that not all of these 4,500 Phoenix investors here are oil and gas experts and/or have a strong personal conviction either. In any case, and while I understand that the advertised coupons can look attractive, Phoenix is not a good fit for us personally for three primary reasons. First and foremost, Phoenix is too early stage and too leveraged for our taste. Phoenix presents a business model that may not be implausible in principle, but like the entire highly competitive oil and gas industry that they operate in, Phoenix is highly dependent on how oil and gas prices will develop and whether they can keep their costs low enough to have a profitable business. They've made big strides since their founding in 2019, but they are still a young and fast-growing company with a limited track record that has taken on a lot of debt. And as of their latest financial report, they are still not profitable, which in my mind means that they probably don't have all that much wiggle room if something goes wrong. For example, if their growth slows and/or oil prices come down. As a point of reference, in their annual report for 2024, Phoenix has a section on its 2025 outlook. And these projected revenue numbers here for the year, they're based on an average benchmark commodity price of $71.98 per barrel for crude oil. And this is where the price per barrel of crude oil is at the time of this taping. So if you decide to move forward with a potential investment in Phoenix, it may make sense to see where oil prices are at that point in time and what your personal expectations are for the future. Second, Phoenix's bonds are structured as a private placement, meaning that they may have limited liquidity if we ever wanted to sell and or need access to our principal before maturity. Because these bonds are not registered and cannot be traded freely, our best option in this case would be to redeem the bonds early with Phoenix, which they may or may not be able to do, as we already discussed earlier, bringing us to the third reason. Phoenix can call the bonds early at their discretion at any time and without any penalty, thereby exposing us to reinvestment risk. This also means that we can't really fully rely on the income stream like we would be able to do with a non-callable bond. So that's a fair bit of risk in my mind if we were to invest in Phoenix. And this is in addition to all the standard risks of bond investing. For example, an investment in Phoenix, like with all corporate bonds, is not guaranteed nor insured by the FDIC. Plus, these specific bonds are unsecured and subordinated, meaning they may rank near the bottom of the debt hierarchy in the case of insolvency. Bond beginners, folks, please refer back to Module 10, Video D for more details on corporate bond hierarchies. Having said all this, if I did believe in Phoenix's leadership and business model, and I was tempted by these attractive rates, here are 3 additional factors I would consider. First, as part of an overall diversified portfolio, I would only invest a sum in Phoenix that I could, in the worst case, afford to lose, and especially if I were investing my retirement savings. Even though Phoenix explicitly mentions IRAs. Personally, we would not position Phoenix as a main pillar of our anticipated retirement income stream. As I said, it's just not the right risk profile for us in such a case. Plus, the bonds are callable at any time at Phoenix's discretion, which takes away the element of stability and predictability I would expect from a retirement income stream. Second, I would be inclined to stay on the shorter end of the maturity spectrum and forego the highest rates with the longest time to maturity. Perhaps accept 9% for 1 year here as a start instead of shooting for the 13% that comes with an 11-year maturity. 13% sounds great, but 11 years for such a young company in a highly competitive and volatile industry may be a long time, at least in my mind. And third, I would choose to get my interest paid monthly rather than have that interest accrue and paid out at maturity. Not only is it nice to get regular payments, a high monthly coupon will also mitigate my risk to a certain degree because I will at least get some cash even in the worst case scenario. So that's me and how I would think about Phoenix. But as I always say, everyone's financial journey is different, and past performance is not indicative of future results. Let's say that you are an accredited investor and you can meet Phoenix's relatively high minimum investment of $25,000. Would you invest in Phoenix? Why or why not? And if not, what else would you consider instead? Drop a comment below and let me and the community know. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing and building a bond portfolio while rates are good levels, then check out this video here on our bond courses. And for those of you who subscribe to Your Financial Journey, check out Ava's and Caitlin's video here on President Trump's Man of the Hour on tariffs and the economy, Treasury Secretary Scott Bessent. There's more than meets the eye to Scott Bessent. In the past 2 weeks, he's basically almost single-handedly stabilized the markets and prevented a complete breakdown in our tariff talks with China. I've linked all the details on that video, our bond courses, and our YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.